All right, so let's talk about the Fed. They just made a massive move, and believe me, it is sending some incredible shockwaves through, well, pretty much the entire market.
So picture this. The Fed has basically turned on the money spigot, full blast. We're talking tens of billions of dollars flooding into the financial system every single month. And the big question on everyone's mind is, where's all that cash actually going to go?
From stocks to gold, even crypto, everything is reacting. So our job today is to connect the dots for you, to see how this one decision is causing all this chaos. Okay, let's get right into it. So what is the deal with this big announcement? Well, officially, the Fed is kind of playing it cool, calling it just a technical adjustment. But the market? Yeah, the market isn't buying it. Okay, so here's the official line versus reality. The Fed's calling it reserve management. Sounds pretty boring, right? But if you ask anyone on Wall Street, they'll tell you if it looks like a duck and quacks like a duck, it's probably quantitative easing. Yep, the good old money printer is back, getting ready to flood the markets with cash. And we are not talking about chump change here. Let's break down the numbers. They're planning to buy $40 billion in short-term T-bills. Think of those as government IOUs. Then they're adding another $14.5 billion just by rolling over existing debt. Do the math, and that's about $55 billion getting pumped into the system every single month. And get this, Wall Street thinks this is just the opening act. Big banks are already putting out projections that the Fed could end up buying over $500 billion in bonds by 2026. That absolutely blows past what everyone was originally expected. In fact, you've got analysts out there already saying that if this massive cash injection isn't enough to keep interest rates low, the Fed is just going to escalate. They'll start buying longer-term bonds. And at that point, well, there's no more hiding it. That's full-blown QE, no questions asked. So, the Fed unleashes this tidal wave of cash. What happens next? How did the markets react? Well, to put it simply, they went wild. It was pure euphoria. It's probably no surprise, but stocks just took off. I mean, the S&P 500, new record high. The Dow Jones, new record high. Even the smaller companies, the small caps, they all shot up to new highs too. Now, this is where things get really interesting. Let's look at precious metals. Gold has been doing fine. Yeah, it's rising. But silver has been on an absolute tear. It is just crushing gold right now, hitting record after record, something to keep an eye on for sure. And all this new money from the Fed, it's had this incredible calming effect. Just look at the bond market. Volatility has collapsed, hitting its lowest point since way back in May 2024. Now, why does that matter to you? Well, because a calm bond market is like a green light for investors. It gives them the confidence to go out and chase bigger returns somewhere else. All right, so stocks are up, metals are up. What about crypto? Well, that's where the story gets a little more complex. It's like a tug of war is happening. On one side, you have some really good news out of Washington, but on the other, you've got the big institutional money, and they seem to be hesitating. So, let's talk about the good news first. The regulatory scene in the US is actually looking pretty friendly for once. You've got Congress pushing to let crypto into pension plans, which is huge. There's a key bill making progress, and regulators are even starting to loosen up some of the tighter rules. I mean, you have the chairman of the Senate Banking Committee himself, Senator Tim Scott, coming right out and saying it. He said after talking with top banking execs, they are making real progress on a bill that could make America the crypto capital of the world. That's a pretty big statement. So, with all that good news, you'd think crypto prices would be soaring, right? But they're not. And to understand why, we have to follow the money. And I mean the big money, the institutional cash flowing through ETFs. And that story is, well, it's a lot more cautious. Believe it or not, we're actually seeing a ton of money flowing out of both Bitcoin and Ethereum ETFs. We're talking 77 million pulled from Bitcoin funds alone. But here's the twist, and this is so important. While some are selling, the really big players, guys like BlackRock and Bitwise, they're doing the opposite. They're seeing this as a discount, a buying opportunity, and they're scooping it up. So what you have is this battle, right? It's the short-term sellers versus the long-term believers. And that fight is creating this sort of stalemate, which is why Bitcoin is really struggling to punch through that big psychological wall right around the $95,000 mark.
Okay, to really get the full picture here, let's zoom out for a second and look at a few other key market signals. These will tell us a lot about where investor mood is right now.
And what we're seeing pretty much across the board is confidence. The US dollar, it's falling. The VIX, the market's fear gauge, super low. Oil prices are dropping even with all the geopolitical drama. And maybe the biggest tell, the riskier stocks, the cyclicals, have been beating the safer ones for 15 days in a row. This, my friends, is what we call a classic risk-on environment. It's when investors are feeling bold, they've got pockets full of cash thanks to the Fed, and they're not afraid to take on more risk to chase those higher returns in things like stocks. So let's tie it all together. We have a market hitting all-time highs, but it seems to be floating on a sea of money created by the central bank. And that brings us to one final and maybe slightly scary question. What happens when the music stops? What happens if the Fed ever turns that money printer off? If you found this video helpful, be sure to smash that like button and subscribe so you don't miss your next Daily Edge. More news in our Telegram channel in the first comment. See you next time.